Hi, I'm Sparsha, your management consultant. Shark Tank India has become a national phenomenon, showcasing the incredible entrepreneurship spirit that's sweeping the nation. Today, we're diving into a fashion brand from season 3 that had the sharks intrigued with its quality and mission statement, but ultimately stumbled due to some important missteps. Imagine this: you're pitching your company to investors seeking crucial funds, but your bank account is empty despite having previously raised rupees 10 crores. A risky gamble, wouldn't you say? That's the same situation that Aste found themselves in. Founded by Jivika Tyagi and Kanupriya Mundra in the thick of the 2020 pandemic, Aste was on a mission to become one of India's leading sustainable and size-inclusive athleisure brand. They entered Shark Tank India with high hopes, seeking rupees 80 lakhs for 2% equity, valuing the company at a whopping 40 crore rupees. But despite the promising concept, they left the tank empty-handed. Their exit highlighted a glaring gap in the market for size-inclusive athleisure wear, a gap they sought to fill with their brand philosophy of take it easy, leave Aste. Their goal was to create a versatile clothing that seamlessly transitions from home to workouts to social events. While the Sharks admired Aste's mission and the quality of their products, red flags were raised about the brand's financial health and marketing strategies. In this video, we'll break down these red flags and explore how Aste can turn them into green flags, paving the way for a successful comeback. First, high inventory and lack of demand forecast. The problem that Aste faced was that they had an excessive stock accumulation of rupees 1.5 crore, resulting in high inventory levels on account of insufficient demand forecasting. This led to financial difficulties for their company. Solution: as per industry standards and competitor benchmarks, inventory stock-up should not surpass 1 to 1.5 months of sales. Based on peak sales of June 23, it made sense for the company to stock approximately 50 to 75 lakh worth of stock and not 1.5 crore. Demand forecasting is crucial when deciding whether to increase production of existing stock or to launch a new product. In this case, the purchase order was placed excessive to the amount of inventory that the company should hold. Studying this data could have resulted in the purchase quantity being reflected correctly, preventing the accumulation of dead stock. Second, lack of branding affecting social media performance. The problem Aste faced was a lack of consistent branding, with no product or marketing campaign reflecting their brand mission of take it easy, live Aste, which was also evident from their return on ad spend being below 1.2, indicating a very big challenge since their business relied heavily on ad spending. Inconsistent brand voice and unengaging content on social media led to low consumer engagement and a lack of repeat customers. When they switched to zero ad spends, sales dropped to zero, highlighting issues such as lack of brand connection, awareness, customer relationship building, and a PMF. Solution: addressing the core issue of brand personality is extremely important. Aste needs to create a core USP and carry it across all their product ranges and not just one, to create cohesiveness. If they are heavily dependent on just the online channel, which is not recommended, they need to improve their online content. Creating a strong brand voice and engaging content to interact with customers should be their focus. Additionally, they should reduce over-reliance on social media platforms and explore alternative marketplaces like exhibition and textile expos. These events offer opportunities for on-ground interactions with customers and peers, fostering stronger relationships that can reduce dependencies on ad spends. And further, building a loyal customer base is crucial for a brand success, and understanding customer needs and ensuring brand visibility through various channels is extremely important. Third, lack of product market fit or PMF and ground zero analysis. In the startup world, achieving a PMF is very important. However, many brands fail due to inadequate analysis before launching their products. This was the situation with Aste. Their initial success was built on shaky foundations. Limited research led to short-term success but failed to create a lasting brand identity. They ordered inventory without understanding the performance of their products, buying trends, or reason for the low return on ad spends. Consequently, they faced excess stock and dwindling profits. Solution: to avoid these pitfalls, brands should adopt a more cautious approach. Rather than going all in from the start, they should test their product in small batches and in limited geographies to assess product demand and its performance. If it sells well, they can increase the order quantity and their reach. If it underperforms, they can offer discounts or clear stock through sales and then identify alternative strategies. This plan, similar to Little Box's approach, which also featured on Shark Tank Season 3, can help generate significant revenue. Conducting a thorough ground zero analysis is essential for brands to gain insights into customer reactions to their goods. This analysis is more manageable on a smaller scale, allowing for experimentation with their design innovation, understanding consumer needs, and refining the product as necessary. Once the product is perfected and customer satisfaction is assured, brands can seek funding and expand their business operations on a much larger scale, achieving long-term success in the competitive Indian market. This strategy has been tested and proved in the past for successful businesses like Empire Spices and Foods, which has grown now into a multi-crore empire. Fourth, lack of money management. Despite their passion for businesses, the entrepreneurs acknowledged themselves that they had no money in their bank account, despite previously raising rupees 10 crores. Poor financial management was a primary factor in this situation. They gave more importance to marketing expenditures over crucial aspects like brand and product development, market research, etc. Solution: to effectively manage their finances, they should implement the Boston Consulting Group BCG Growth Share Matrix, which involves classifying products into 4 categories. First, cash cows. Identify your hero products that can generate the most revenue. Second, pets. This is where you experiment with new launches in smaller quantities to test the market response. Third, question marks. Treat these products cautiously as they might be easily copied. Fourth, stars. While profitable, they also require high investments. By identifying your stars and cash cows, Aste, which also had the potential to make EUL, which was extreme uplift leggings, into their cash cows, could have allocated resources more smartly. For solving the current predicament, to address their dead stock issue, the company should give importance to liquidating the stock and recovering money from their delivery agents amounting to rupees 30 lakhs as soon as possible. This will enable them to create outstanding payments to Meta, which came to rupees 1 crore. The excess cash left can be used to further drive ad spend. The following table outlines the potential revenue that they can generate based on different pricing strategies for their unsold inventory. If they sell stock at the break-even cost of rupees 1.5 crores, it will lead to excess cash of 80 lakhs, which can generate additional sales of rupees 96 lakhs at the current ROAS. Selling the stock at a 30% margin would result in a revenue of rupees 2.1 crore and would lead to excess cash of 1.4 crores, which can generate additional sales of rupees 1.68 crores at the current ROAS. Selling the stock at the MRP cost of rupees 3 crores would lead to excess cash of rupees 2.3 crores, which can generate additional sales of rupees 2.76 crores at the current ROAS. Their road to success will surely require strategic decision making and a deep commitment to their customers. With a focus on PMF and a customer-centric approach, Aste can build a loyal customer base and create a lasting impact in the fashion industry. While the Shark Tank experience may have been a temporary setback, it has provided important lessons for Aste that have the potential to redefine the athleisure market and inspire others to embrace sustainability and inclusiveness. Will Aste rise from the ashes of Shark Tank and redefine the athleisure market? Only time will tell. If you enjoyed this video, don't forget to like, share and subscribe for more brand and business insights. Also, let us know in the comments which brand we would like us to dissect next.